Hello and welcome to CRI's tax webinar covering the tax reform spotlight on business. Today we're going to go through some of the major implications of last year's tax reform and specifically how it impacts businesses. First, we're going to start with a few housekeeping issues. This webinar will be recorded, and that recording will be available to everyone who registered. It'll be sent out very soon after the webinar completes. Additionally, I wanted to draw your attention to the Handouts tab in GoToWebinar. There are two handouts that you're able to download and take with you that kind of summarize some of the salient points we'll be covering today. If you do have any questions, all phone lines are going to remain muted through the duration of this webinar. So we do encourage you to go to the Questions tab and enter any questions you have in that tab. We'll try to get to as many questions as we can during today's webinar. Lastly, CPE credits will unfortunately not be available for this webinar. Some of the topics we're going to be covering on today's business webinar is we're going to start out covering what various methods of accounting have changed due to the tax reform. Next, we're going to go through a very hot topic, the pass-through deduction. We'll then move into some of the new rules on bonus depreciation in Section 179, also known as full expensing. Then we're going to go a different direction and talk about some of the new limitations under the tax reform, and we'll wrap up with some additional provisions and notes to keep in mind as you evaluate how the tax reform will impact your business. First, let me introduce all the CRI professionals on the call today. My name is Kris Hoffman. I'm a partner in the Nashville, Tennessee office, and I also oversee the tax function for the firm. I have two boys, 5 and 8, and also enjoy my 2 Boston Terrier puppies. When I have the time, I like to travel to Hilton Head as well as watch football from my alma mater, the University of Tennessee. Eric Leib is a partner in our Dallas, Texas office. He got his undergrad from the University of Texas and his master's degree from the University of Memphis. Eric has 2 daughters and likes to travel, recently coming back from Spain. He also has a dog named Louie. Alicea Cosmo is a partner in our Jacksonville, Florida office. She's been married for 8 years as of this past New Year's. She got her degree from the University of North Florida. She also likes to travel, but her interest is in playing pool, where she travels and plays in pool tournaments. She also has a dog named Thibodeau. So now we're going to start out in the various methods of accounting, and Eric's going to discuss what various options businesses now have with the tax reform.
Thanks, Kris. Appreciate the introduction. Hope everyone out there is doing well this morning. I know there's a lot of inclement weather out there. Appreciate the time everybody put into joining us today. You know, the best part of the tax law changes for businesses, it gives you a great opportunity to step back and look at accounting and business decisions you made years ago. You really have to look and see, are there better ways of doing things now? Are there ways you can improve your tax position? The tax changes have really opened up some opportunities for taxpayers. The cash method of accounting is seen as an easier way to account for your books and records. And there's some changes under the new law that really will open up some opportunities. In the past, C corporations were really limited to the use of the cash method of accounting. They were limited in the sense that if their prior 3-year average gross receipts were greater than $5 million, C corps were precluded from using the cash method of accounting. And it's just as a sidebar here, I'm going to use this 3-year average gross receipts test. Keep in mind, it's the prior 3-year average gross receipts, so it's the 3 previous tax years that we're talking about. So under the old law, C corps were really limited to the use of the cash method of accounting. Under the new law, they've really expanded who can use the cash method of accounting. Now this 3-year test is $25 million, so it's really increased quite a bit and made more available for C corps to use the cash method of accounting. I also want to make sure you understand that this also applies to partnerships that have corporate partners. So if you're a partnership You have more than individuals as your partners. You have corporations. Now you're able to take the cash method of accounting based on the $25 million rule here. So just want to make sure you're aware of that. The next area we're going to talk about is the accounting for inventory. To delve further in the use of the cash method, you may have been precluded in the past from using the cash method because you had inventory and you were not eligible to use the cash method of accounting. Under the old law, taxpayers other than C Corps, so keep that in mind, the old law didn't apply to C Corps. Taxpayers in certain industries with a 3-year average of $10 million or less could use the cash method of accounting if they had inventory. What they would do is they would account for the inventory as non-incidental materials and supplies. Well, what I want to do is explain a little bit about what that means, the non-incidental materials and supplies. Basically, you still have to keep track of those costs that are inventory type costs under the non-incidental material and supply rules. But what you do is you deduct those expenses in the later of the year that you deliver those items to customers for the year you pay for them. So under this old law, you didn't necessarily get an automatic write-off of those purchases. It was still based on the non-incidental material and supplies rule, but you could still have an overall method of accounting using the cash basis. So if you have receivables, payables, you could put everything on a cash basis. Well, they've really opened things up now for taxpayers that have inventory. As I mentioned a minute ago, those old rules didn't apply to C corporations. So C corporations that had inventory were precluded from using the cash method of accounting. Well, under the new rules, C corporations fall under the new rules, and they can use the cash method of accounting for inventory if they have the prior 3-year average gross receipts under $25 million. So they've expanded the rule from $25 million from the original $10 million for entities other than corporations. So now corporations can fall into the same rules as partnerships, other entities that are doing business. So it really opens up the opportunity to use the cash method of accounting, which hopefully will be easier for you to account for. We're going to go a little bit further into the issue of inventory. If you have inventory, you may be familiar with the 263A, the UNICAP rules, the Uniform Capitalization rules. And basically those rules said that taxpayers that have inventory, that have direct costs and indirect costs, they're required to capitalize those costs into their inventory. Under the old rules, the UNICAP provisions kicked in with a 3-year average of $10 million gross receipts in the 3 prior years. Well, they've expanded it now, and now if you're under $25 million for a 3-year average, you're no longer required to follow the UNICAP rules, which can be seen as pretty difficult calculations to keep up with. So in the past, you may have had to do the capitalization, but now under these new rules, you're no longer required to if you meet this new requirement of $25 million over a 3-year average. You'll notice a theme for a lot of these accounting method changes. The new tax law seems to have expanded which taxpayers can use some of these simpler accounting methods. And that we feel that holds true with the long-term contract rules. So if you're a taxpayer in a line of business that has long-term contracts that overlap more than one tax year, under the old rules, if your 3-year average gross receipts were greater than $10 million, you were required to use the percentage of completion method, which could be detrimental to you potentially in a tax year. So under the new rules, they've raised the threshold to a $25 million threshold. So now what this is saying is there are more options available to you on how you want to account for those long-term contracts. So we think that this may be simpler for you, may offer you some opportunities to make some changes on how you account for those long-term contracts. So we'll talk a little bit about what this means to you. How does this impact you as a taxpayer? The first thing that we recommend you do is go back and look at your books and records. We've got this new $25 million test that seems to be all across the board with these new tax changes. If you're above the $25 million threshold for that 3-year period, a lot of these changes may not apply to you, so you may not get the benefit. But you may not have looked at this for years. You may have been subject to the $5 million-ish rules, the $10 million limitation. Well, now you may have an opportunity to go back and make some changes and change how you're accounting for your businesses because of these opportunities that have become available. Next, you want to take a look at your balance sheet. Do you have a lot of receivables and payables on the book? Does it make sense to be cash method? I mean, there's all these changes that are available, but maybe you're still right on target by being an accrual taxpayer. So you'll really want to take a look and see where you stand, and does it make sense to make change? These changes are available, but you may be doing the correct method, the way you've been doing it in the past. So you'll really want to look and see where you stand on those. And then last, one thing to look at, to consider, as I mentioned earlier, you may not have looked at these items for years. If you haven't paid attention and can't remember how you've been recognizing revenue on a long-term contract, this gives you a great opportunity to look back and see what you've been doing, and does it make sense to potentially change how you're recognizing your revenue for tax purposes. So again, those are some things to take away from this. Now I'm going to turn it back over to Kris. I think we've got a polling question here, right, Kris?
That's right, Eric. We have our first polling question of the day. And this has to do with the method of accounting that Eric just mentioned. First polling question is, what method of accounting do you currently use? Do you use cash, accrual, or not sure, haven't looked at this in years? Well, I'll give you a few moments to respond to that polling question. I did want to announce that we've decided to give you some bonus content today. So if you click on the Handouts tab in the Go to Webinar section, it'll actually link you to our individual tax reform update. For those of you that may have attended yesterday's webinar, look familiar. So feel free to go ahead and download those handouts for the individual tax update. But in the questions section, you should see a link to the CRICPA.com website, and that'll take you to the PDF that has the business tax reform one sheet. So again, the handout section will give you the individual tax reform one sheet, and then the link in the questions will provide you the one for the business. Okay? I'll go ahead and close the poll, and we'll look at the results. Looks like we have almost a pretty even split. 46% of the people are on the cash method, 52 accrual, and then a small segment that needs to circle back on that topic. So now we're going to go into the pass-through deduction, and Alicea is going to educate us a little bit about how that's going to work.
Thanks, Kris, and thanks everybody for coming and spending some time with us today. I hope you're staying warm out there. So one of the biggest changes to come from the Tax Cuts and Jobs Act, and possibly one of the most complicated, was this deduction for pass-through entities. And we really, not going to have enough time today to go into a lot of details. We definitely recommend that you use the link at the end to maybe schedule an appointment with one of our CRI professionals to go over your specific situation. But I'm going to kind of go over the basics of it right here. So as you may have heard, the new corporate tax rate for C corporations is 21%. And so if you have a pass-through entity, an S corp, a sole proprietorship, or a partnership, that's going to be reported on your personal tax return and taxed at your individual tax rate, which under the new tax rate brackets could be as high as 37%. So to keep that competitive with the new C corp rate, they implemented this pass-through deduction, and it's going to be 20% of your domestic qualified business income, which is basically just income from any trade or business that's not going to include investment income, and that's also not going to include compensation that you receive as a shareholder or guaranteed payments to you as a partner. And then this deduction is going to be taken below the line. So what that means is it's going to reduce your taxable income and not your adjusted gross income. So if there are other items in your tax return that are limited based on adjusted gross income, they will not be affected by this. It also does not lower self-employment income, so it's not going to affect self-employment taxes either. And this deduction can be taken whether you itemize or take the standard deduction. I know a lot of you will probably be, a lot more of you will probably be taking the standard deduction with the higher rates, and but you'll still be able to take this pass-through deduction either way. And it's going to be available for tax years 2018 through 2025. So we'll have to see after that point whether or not Congress decides to extend it, or they come up with something different. And just a couple notes: if you have a loss from your qualified business income, that's going to be carried forward to the following year in the calculation of the next year's qualified business income deduction. And the deduction cannot exceed 20% of your taxable income minus your capital gains, so just a note there. And the deduction is calculated for each entity individual. So if you have 5 pass-throughs and 3 of them have income and 2 have a loss, you'll get a 20%, potentially a 20% deduction on the 3 that had income individually. Go back. Okay, so the 20% deduction could have some limitations, and that's kind of based on whether or not your taxable income is over certain thresholds, which we'll go over next. And those limitations can either be 50% of your W-2 wages, which is just wages that are reported on a payroll report, so that's not going to include 1099s and independent contractors, or 25% of your wages plus 2.5% of qualified property. And that qualified property is any depreciable property that is in service, and you include that in the calculation for the life of the property. So if it's 15-year property, then it's included in the calculation for 15 years. And they kind of added this second part, the 25% and the 2.5%. Kind of last minute, and that's really to help out like real estate industries, manufacturing and construction, just any industry that is more capital intensive and maybe doesn't have as much labor. And one thing to kind of think about there, if you are in one of those industries, is to consider increasing investment in that qualified property in profitable years to increase the amount of deduction that you're going to get. And then certain industries could be excluded from taking this deduction. And those are going to be your service industries where you're selling a skill and not a product. So examples of that are doctors, lawyers, accountants, consultants, athletes, basically your professional service companies. And as taxable income starts going over a certain threshold, those industries can possibly take a percentage of the deduction and maybe exclude it completely. So if you're under those thresholds I was talking about, which is $157,500 for individual taxpayers and $315,000 for married filing jointly taxpayers, there's no limitation. It's just 20% of your qualified business income. Doesn't matter what industry and if you're specified service, it's just you get the deduction. But as you start to go over those thresholds, so for individuals, as you go from $157,500 to $207,500, and then for married filing joint, as you go from $315,000 to $415,000, there's a calculation that will allow a percentage of that deduction, and it just depends on how far over those thresholds you have gone. And then for specified service industries, only a percentage of qualified business income is allowed over those thresholds as well. So they're subject to 2 limitations. And then once you get over those thresholds completely, the specified service industries will no longer have a deduction. So if they're over $415,000 married filing jointly, they get no deduction. If you are not a specified service industry and you're over those deductions, you're just limited completely to that either 50% of wages or 25% of wages and 2.5% of property. Simple, right? We're all going to be able to file on postcards. All right, so we've got some examples here of how this deduction works. So in all 3 of these examples, we're assuming married filing joint status. And in this first example, we have a sole proprietor CPA. All of their taxable income comes from their accounting work, and but because their taxable income is under that $315,000 threshold, there's no limitation, even though they don't have any W-2 wages or property, and so they get the full 20% deduction, and that's going to be $60,000. In the second example here, we have a highly successful attorney who's a partner in a law firm and receives a K-1, and most of his taxable income comes from that K-1, so $800,000. He has allocable W-2 wages and property from that law firm of $1 million. But he also falls under that specified service industry. And so because he's over that $415,000 threshold, there's no pass-through deduction allowed. And then in the third example, we have someone who's an entrepreneur and investor, and they receive most of their income from investments, but they also have some qualified business income from pass-through entities and some allocable W-2 wages and property from those pass-throughs as well. So they're limited to that 50% of W-2 wages, and so their deduction is going to be the $5,000, which is 50% of the W-2 wages. So just to kind of go over how this can impact you and some things to be thinking about, could impact your entity type selection. We've gotten quite a few questions about this, and it's still kind of early to make a big decision like that on whether or not you want to switch to a C Corp, or if you're a sole proprietorship, maybe you want to look at being an S Corp. So it's going to take some time to see how this deduction plays out and how it affects your taxable income. We do have a chart, I think Kris mentioned, in the GoToWebinar on entity type selection. And like I said, you can definitely give one of us a call and kind of work through your situation. Could also affect your state income taxes. So some states start with your adjusted gross income in calculating the state taxes, and some start with taxable income. So in those states where they start with taxable income, that is reduced by the deduction and can be impacted. And then if you have a business that maybe includes a sales and a service component, you might want to consider restructuring and splitting those into two separate businesses, so that maybe the side of it that is based on sales of property could benefit from this deduction. And then the other thing is to just consider timing of your capital investments. If you are in one of those industries that is more capital heavy rather than labor, you might want to look at making any capital investments in profitable years so that you can take advantage of that 2.5% component. And then just the other thing to kind of take away is there's still a lot of unknowns with this. We're getting guidance constantly from the IRS on how this is going to work and how it's going to be calculated and how it's going to impact different industries. A lot of questions about, if you have payroll in one company and you have another related company that doesn't have payroll, can you allocate or attribute some of that payroll across related party companies? And what if you have, a partnership that has an interest in other partnerships? How is that flowing through and impacting your return? So the bottom line is the IRS is going to be issuing a lot of regulations and technical corrections, and we'll stay on top of that and keep you up to date on how that's going to impact you. And I think Kris has another polling question for us.
Yes, thank you, Alicea. Next polling question has a little bit to do with what Alicea was just mentioning. With the new pass-through deduction, are you planning on changing your legal entity structure as part of this tax reform? Yes, I've already started that process. Our second choice is no, not enough benefit to change. Or option C is undecided, I need some help. And while we give folks time to register their poll results, I did want to ask you a question to clarify something that we've gotten from a few audience members. Alicea, can you clarify that on the W-2 wage limitation, whose W-2 wages are you referring to?
So these are wages that are paid to employees of the company. This is not going to include, like if you're an S corporation shareholder and you are receiving a W-2 yourself for reasonable compensation, the wages that are being paid by the company to you and to the other employees are included in the calculation. But as far as the qualified business income, it won't include your compensation in the income. And then it's what's being allocated to you. So if you're a 50% owner in the company, then you'd be allocated 50% of the W-2 wages. And hopefully they'll kind of adjust the K-1 forms to reflect that going forward.
Right. Yeah, I think that's where the clarification comes in. Is you'll be allocated your portion of the business's W-2 wages solely for the purpose of that W-2 limitation. Thank you for clarifying that. I'll go ahead and close the poll question now, and we'll look at the results. And looks like not too many people are planning to change their legal entity right now, or not too many people have started changing their legal entity. 57% don't think they'll change their legal entity, but another 40% are undecided or need some help. For those undecided, as Alicea mentioned at the end, we're going to offer a link to contact CRI, a local CRI office. And for those undecided people, feel free to reach out on that link. Get someone in your local CRI office who can sit down with you and kind of think through whether your legal entity structure still makes sense. Now, Alicea is going to continue with covering some of the bonus depreciation and Section 179.
All right, thanks, Kris. So one of the, kind of call it a Christmas gift to come from the tax law, is some increased bonus depreciation and Section 179 limits. So under this new tax reform, the Section 179, which most of you may know is the election to expense the cost of qualifying property up front rather than capitalize those and depreciate them over time. And for 2017, those limits were you could expense $500,000, but if you had invested more than $2 million in property, it started to phase out. And for 2018, that amount is going to be $1 million, and it doesn't start to phase out until you've done over $2.5 million. So an extra $500,000 there in deductions, so that should really help quite a few people out. And the tax reform also expanded the definition of what qualifies for Section 179. So they've included tangible personal property used to furnish lodging, and then the big one here is improvements to commercial rental property. So if you've added a new roof, heating, ventilation, air conditioning, those are now going to qualify for Section 179. And then things that have always qualified for Section 179 are depreciable, tangible personal property, off-the-shelf computer software, and qualified rental property, which I'll talk a little bit more about in a minute. And then the other higher limit that they've added in the tax reform is to bonus depreciation. And so for 2017, the amount that you could take on bonus depreciation was only 50%, and you could only take that on new property, so it had to be a first-time purchase. And this is one of the few things that is actually going to impact the 2017 tax return. Most of the things that they've implemented start January 1st, 2018. But this new 100% bonus depreciation is available for purchases made after September 27th, 2017. Now, the law didn't get signed until December 22nd, so it didn't give you a lot of time to take advantage of that, plan for that. But if you did happen to make purchases in that last part of the year, you will get to benefit from this 100% bonus depreciation. And they've also, if you notice in the first and second brackets there, they've changed it from just new property to now you can take it on new and used property. So no longer have to be a first-time purchase. And this 100% bonus depreciation is going to apply, like I said, to the last part of 2017 and then the next 5 taxable years, so 2018 through 2022. And then it starts to phase out over the next few years until 2026, at which point there's no longer any bonus depreciation, unless, of course, Congress decides to expand that or continue that into the future years. So for the next 5 years, you really have, and really in 6 years, you have 80% is still quite a bit. You have the ability to take that 100% bonus depreciation on new and used property that you purchase. And just like the Section 179 definition, they've expanded the definition of what qualifies for bonus depreciation. So that now includes qualified improvement property, which used to be split into 3 categories, which is qualified leasehold improvements, qualified restaurant property, and qualified retail improvement. And each one of those categories kind of had its own rules and what qualified and how to handle that. Well, they've eliminated those 3 categories and have now just looked at qualified improvement property across the board, which is just improvements to the interior portion of a building. So anything that's not structural, anything that you can kind of replace or remove in the interior portion of a building. And that doesn't include improvements attributable to the enlargement of the building, so the elevator, escalator, internal structure framework. And so just kind of a look at how this could impact you. You know, you might want to look at timing of capital investments and expenditures. Like I said, the 100% bonus depreciation is available for the next 5 years, so it might be a good time if you were looking at doing some improvements and purchasing some equipment. This might be a good time for it. And then also looking at how to classify expenses between repairs and maintenance, or whether or not they need to be capitalized. By having these, you know, Section 179 limits and 100% bonus depreciation, kind of reduces the risk of incorrectly classifying those things, because you're able to expense them through these regulations. And then once again, it affects state income taxes. So in the past, there are a lot of states that have not conformed with the federal rule regarding bonus depreciation. So if you operate in one of those states, you may have to keep a separate set of books, which we can help you with, and figuring out the depreciation for those states. Another thing to consider is if you are going to have a loss for the year, or if you have an NOL, you might not want to take advantage of that 100% bonus depreciation, because it can add to or create an NOL. So, you know, if that's going to be the case for you, you might want to defer those depreciation deductions to future years when you are going to have income. And as Eric's going to talk about next, there have also been some changes to NOL limits and how you can deduct those on your tax returns. And send it back to Kris for another polling question.
Thank you, Alicea. Well, this is our last polling question of the day, and it has to do with those that qualified property that Alicea just told us about. Do you expect to purchase qualified property this year for either Section 179 or bonus depreciation? Yes, but you don't expect to exceed that $1 million limit. Yes, but you probably will exceed the $1 million limit. Or no, you're not going to really change your purchasing decisions based on the new Section 179 limits. While we give people a few moments to respond to that polling question, I did have one more question that came through on the pass-through deduction, Alicea, that I hope you can help clarify for people. This question has to do with if someone holds a partnership interest just as a side investment, and then also is an employee in a different enterprise that has W-2 wages, can they use their W-2 wages that they earn from their business and apply that towards this partnership that they also own as an investment?
That's a good question, Kris. So as far as we can tell, it's really just the W-2 wages that are being paid by the pass-through entity and the percentage of those that are being allocated to you. So it doesn't seem likely that you'll be able to use your W-2 wages from another entity or another job to allocate and use in the calculation of this deduction.
Thanks, Alicea. I agree. The way it's currently worded is you compute your pass-through deduction on a business-by-business level, so you can't kind of cross-utilize W-2, either your own or another business's W-2 wages for the purpose of that calculation. I'll go ahead and close the poll now, and we can look at the results. A little over half of our people attending will be purchasing qualified property, but don't expect to exceed the $1 million limit. Almost 40% said they're not going to change their buying habits from this new Section 179 limits. And the other 12% are really going to try and take a benefit and expect to purchase more than $1 million. So now I'm going to pass it off to Eric, who's going to flip things around. We've been talking about all the good things the tax reform has offered the businesses. Eric's going to now tell us some of the new limitations that the tax reform also has.
Thanks, Kris. I just realized you guys really set me up here. I've got to follow Alicia's talk about the pass-through deduction, which everybody's talking about and everybody wants to know about. Now I get to tell everybody about the bad stuff in the new legislation. So thanks. I appreciate that. I'm the bad guy now. But let's get started, and we'll go over some of these new limitations. And the first limitation that we have here is net operating losses. And you're probably aware of the net operating loss rules. And under these rules, essentially taxpayers that have taxable losses for businesses, that's net deductions over net revenue, a loss. Under the old rules, you could take that loss back 2 years, and then if you had any additional carryover, you could carry that forward up to 20 years. You were able to offset just about any type of income with those business net operating losses, and whether it's investment income, et cetera, you were able to fully utilize those losses. The only area that had a little bit of a limitation for net operating losses, alternative minimum tax purposes. A lot of people are probably aware, if you were in alternative minimum tax, you were only able to offset 90% of your alternative minimum taxable income with the losses. So you did have a little bit of your income that could be subject to alternative minimum tax under the old rules. Well, here's where some of this comes in that's not so great, the new changes. The first thing is, under the new rules, there's no longer a carryback of your net operating loss. So if you have a profitable year, you're paying tax in year 1, year 2 rolls around, something happens, not as profitable, you may have lost money on a taxable basis. Well, you can no longer carry that loss back to the profitable year and recoup some of those taxes you paid in the previous year. So this really could impact taxpayers that go from a profitable year to a not so profitable year. The next thing is could be beneficial. You're able to carry forward your net operating losses indefinitely. So now that you can't carry them back, you're able to carry those forward as far as you can. The funny thing with that is, under the old rule, you had 20 years. Hopefully taxpayers were able to use those losses within the 20 years. I know that maybe certain situations they weren't. I don't know how impactful this change is going to be to be able to use those losses indefinitely, but it is something. So keep that in mind, that you don't have to keep track of the carryover like you did in the past. The other thing that could really impact you as well, and this kind of gets back to one of the comments Alicea made about accelerating deductions, you're only able to use your net operating loss forward against 80% of the next year's taxable income. So if you have an NOL generated in year 1, you carry it forward to year 2, you're still potentially going to be subject to tax on 20% of your income in year 2 if year 2 is a taxable year. So you're not going to be able to fully utilize that NOL in the subsequent year. But you don't lose the loss. It just continues to carry forward. But each year will be subject to this 80% limitation. So you'll want to keep that in mind. So really the key here with the net operating loss is the takeaway from here is there's no carryback, and then you have this 80% limitation rule that you're going to be subject to. So those are some areas to keep in mind. If you traditionally had losses that you've rolled forward, you may find yourself in a taxable position in future years because of that. Under the old rules, there were some exceptions with the carryback periods. Well, now that we really don't have carryback periods, those exceptions, you don't have to keep track of them. You used to be able to carry back certain losses 3 years for casualties, 5 years for farm losses, and potentially 10 years for certain other situations you could carry back losses. Well, now that we don't have the carryback rules, those timing issues kind of go away. There is one thing I do want to point out, though. Farmers still are eligible for a 2-year carryback, so they did leave some benefit for farmers that have losses to carry those back 2 years. But other than that, taxpayers are really required to carry those losses forward. So again, as Alicea alluded to, you'll really want to make sure you're timing any accelerated deduction so that you don't generate an NOL and become subject to these additional requirements. So another area that we're gonna talk about that you may be surprised to learn about, and it may sting certain taxpayers, it may hurt a little bit, is the interest expense deduction. In the past, if you incurred an interest expense as part of your business, you probably were able to take a full deduction for that interest expense. There are certain situations where you may have been limited to the interest deduction, but for the most part, taxpayers could fully deduct their interest. Well, they've changed these rules on us a little bit here. The new rules are interest is subject to certain limitations. And this is for taxpayers, this is for larger taxpayers that have the 3-year prior average gross receipts of $25 million or more are subject to these rules. But basically what these rules do is taxpayers that fit that requirement above the $25 million are subject to a limitation of 30% of their adjusted taxable income And in a moment, I'm going to give you the definition of adjusted taxable income plus any business interest income. So you add your business interest income plus 30% of adjusted taxable income to determine how much interest expense you can deduct in the current year. Now, business interest expense, adjusted taxable income has its own definition. And adjusted taxable income is taxable income computed without regard to any item of income, gain, deduction, or loss that isn't part of your allocable trade or business. So these are items that are not part of your business. They do not get factored into the adjusted taxable income figure. The figure also doesn't take into consideration any other business interest deduction or business interest income. It also does not include net operating losses. It also does not factor in the Section 199 Cap A deduction that Alicea was talking about. That's the pass-through deduction. That's not factored into the 30%. And also, they've given a little reprieve over the next few years until January 1st, 2022. The adjusted taxable income does not include depreciation, amortization, or depletion. So for the next few years, when you're calculating this adjusted taxable income, you don't have to reduce that number by your depreciation, amortization, or depletion. Eventually, that will kick in after 2022. Starting in 2022, you will have to take those deductions. So just want to make sure you're aware of that. There are some benefits when you're calculating the adjusted taxable income number. Also want to make sure you follow that this calculation is done at the entity level. So if you have flow-through entities, partnerships, the calculation will already be done for you, and the limitation will be accounted for on your K-1. So you won't have to do a subsequent calculation when you receive those K-1s. It'll already be accounted for, and you'll have your number, your limitation already applied to you. So again, this could really bite taxpayers that are highly leveraged, that have a lot of debt on their books that they need for their businesses. If you're above this $25 million threshold, you could have some limitations on how much interest you're deducting currently. Oh, again, the interest expense I may not have mentioned. The interest deduction, the deduction is carried forward to the extent you can't utilize it in the current year, so you don't lose it. But you have to remember, year after year, you're going to be subject to these limitations. But it does carry forward. You don't lose the deduction. So the next one is going to make me less endearing than the first two, and that's related to entertainment expenses. They've really taken the fun out of the Internal Revenue Code on this one. You know, it's taxpayers that spend money on entertaining clients, they're really going to be impacted by this one. Under the old law, you're probably familiar, entertainment expenses were subject to a 50% limitation, much like your meals were. And so every year, if you had these deductions, you could take 50% of it. Well, under the new rule, they have taken out the entertainment component, and entertainment is no longer deductible. This could have a big impact on clients that do have a lot of entertainment expenses for the year. You'll want to make sure that you're keeping track of your entertainment separately from your meals. Meals will still have the 50% limitation, but the entertainment component will be non-deductible. There are a few examples where entertainment will continue to be deductible, and here are a few of those. Entertainment expenses treated as compensation to an employee, that will still be deductible. Recreational expenses, primarily for the benefit of employees that are not highly compensated, that'll be deductible. And any expenses you've incurred for entertainment that's sold to your customers, that will still be deductible too. So there still are situations where the entertainment expense will be deductible, but by and large, most of your entertainment expenses will no longer be deductible. The next area, if your business has a fleet of vehicles or equipment that is replaced often, then you'll really want to take note of these new changes, and that's related to the like-kind exchange program. You're probably aware that under the like-kind exchange rules, if you exchange business property for like-kind business property, you can defer the gain on that transaction. So you don't have a current taxable event if you do exchange property. So under the old law, you could do this for all types of tangible personal property used in the business, certain intangibles, as well as real property. Well, they've really changed this for a lot of taxpayers, and that real property is still eligible for like-kind exchange treatment. So if you exchange real estate, you're still eligible to do it tax deferred without a problem. But they have eliminated this now for personal business property. So you can no longer exchange vehicles for other vehicles without incurring a potential capital gain, or if you have equipment that you're exchanging, those could really be subject to capital gain. And you'll want to be aware of this, that you may not be able to defer the taxation on property that you're swapping out. So you'll really want to look at this. And as we talked about, a lot of these changes you want to coordinate with one another. And we discussed the acceleration of deductions with the bonus depreciation or Section 179. You'll really want to take that into consideration with this like-kind exchange change, in that if you accelerate the deductions, you may potentially put yourself into a taxable situation if you're swapping out property. So these rules, you have to look at the big picture and kind of take everything together on that. So overall, let's talk about how this impacts you and what you should do as it relates to these changes. We talked about accelerating expenses. The issue with the NOLs could be big. If you accelerate your expenses, accelerate deductions, then you generate a net operating loss, then you have this 80% limitation of how you can offset income. So that's something to consider as you accelerate. The less net operating loss you generate, maybe the better for you, so that you don't have that 80% limitation. The next thing to consider, the cost of borrowing for your business has gone up. If you can't deduct all of that interest expense in the current year, then you effectively have increased your tax for the year. So keep that in mind, that the cost of borrowing may have gone up for you because of the limited deduction you get for the interest expense. And then last, for your vehicles, for your capital improvements, you'll want to keep these in mind, that if you regularly and routinely do these things where you're swapping property out for new property, under the old rules you didn't have a tax hit, but now you could currently have a taxable event by swapping out those vehicles. So you really want to, in those assets, you really want to take that into consideration when you do those business transactions. And things are different now. They're not the same as they used to be. So now we have some other provisions and notes. Hopefully that was the end of the bad stuff in the code. There's a few limitations left, but hopefully we'll end on a good note here, and we'll talk about some of these other changes. This first one is probably one of the hottest topics, aside from the pass-through deduction, and that's the corporate tax rate. As you probably know, the corporate tax rate is now a 21% rate. That's a 21% flat rate. There's no longer a graduated rate for corporations. So the first dollar of taxable income a corporation generates is going to be subject to the 21% rate. Under the old rules, you did have a graduated rate system, so the first few dollars of income were subject to lower rates than the higher amount. So keep that in mind, that this is a flat rate, a flat 21% rate. Also, if you are a service business, you may be familiar with the personal service corporation rules. Under those rules, basically a taxpayer in certain service businesses, they were required to be taxed at the highest graduated rate under the old tax law, which meant the first dollar of taxable income to those personal service corporations was subject to a 35% rate. Well, now that we don't have a graduated rate system, personal service corporations are basically taxed like other corporations. They're taxed at the flat 21% rate. So there's no distinction in tax rates for personal service corporations. So you may want to keep that in mind if this applies to you. Next, corporate AMT has been eliminated. There's no longer alternative minimum tax for corporations. This should be a good thing for taxpayers in the corporate setting. Under the old rules, you had to keep track of taxable income under these two different regimes. You no longer have to do that. No more corporate AMT. Keep in mind, this is for corporations. Unfortunately, they did not eliminate AMT for individuals, so it does still exist in the individual world. This is just for corporations. The next area that has gone away is the Section 199 deduction. This is the domestic production activity deduction. You may be familiar with this. This essentially was an additional deduction of 9% of your qualified activity income. A lot of taxpayers were able to take this deduction in the past. This applied to corporations could take it, as well as pass-through entities could take the deduction. But you'll notice that this is Section 199, and Alicea was talking about the new pass-through deduction, which was the Section 199 Cap A. So essentially, the thought was that the new 199 Cap A replaces this old Section 199. However, as Alicea mentioned, the 199A does not apply to corporations. It only applies, the pass-through deduction only applies to pass-throughs. So this could hurt corporations in that they don't get this Section 199 deduction. However, the corporate rates did go down, so they may be okay in the end. Here's another one, technical termination for partnerships. If you have a partnership, there are certain rules as far as transferring ownership interests. We've seen taxpayers get stung by this. If you have a sale or exchange of 50% greater of a partnership interest, you could potentially trigger a technical termination. And what that means is you basically end the tax year at that point in time and start it the next day. And so you could have a tax year that has two reporting requirements, one for the first period and one for the second period. And where we see this occur is occasionally a client will fail to mention that they did this transaction or they transfer this interest, and the tax return for the tax period has ended for the first period and the next period has begun, and potentially there's a gotcha moment and that there are penalties for filing a late partnership return for the first period. Well, the good thing is technical terminations are gone. We don't have to worry about that starting in 2018. There's no foot fault. You don't have to worry about this technical termination if you have a change in ownership. In addition to the old rules for the technical termination, if you did have a termination, then you potentially have to reset all of your tax elections that you've made in the past. So that's good that we don't have this technical termination. Now the last thing that I want to mention is the excess business loss limitation. You may not be familiar with this, but they have made a big change for flow-through business income that passes through to you potentially. Basically what the excess business loss is the aggregate business deductions over aggregate gross income from your activities on your return. So that could be you have K-1s from S corporations, partnerships, you have a Schedule C on your personal return, you aggregate the income and losses and potentially see what your business loss is for the year. And so the limitation is the aggregate of those income over expenses plus $500,000 for a married couple and $250,000 for an individual. And what this basically does is when you aggregate those losses, if a married couple has greater than $500,000 of loss for the year, they're only able to deduct in the current year $500,000 of that net loss against other types of income. So if you have capital gains, dividends, interest, you're subject to this $500,000 limitation on how much you can, of these losses from your business, you can offset that income with. Again, you don't lose that excess business loss, so the amount of the loss above the $500,000 carries forward as part of your net operating loss. But as we discussed earlier, the net operating loss has deductions now, and you do have limitations. You have that 80% limitation. So there are some issues with that. This limitation, this excess business limitation, occurs at the individual level, not at the entity level. So you may have a large K-1 with a large loss on it, but you have to look at your personal return to determine whether or not you're limited, and if you are, how much your limitation is. So those are some additional provisions in the code and the change. Some good, some not so good. But let's see how this impacts you. You know, all the talk now is converting to a C corporation. I want to be a C corporation. Well, you really have to step back and look and say, does it make sense for me to be a C corporation? You may be fine the way you are and the way you're being taxed currently. The 21% rate is really tempting. People see that. They really want to take advantage of it. But you still have to keep in mind they have not eliminated the double taxation regime. So shareholders potentially are subject to a tax on any dividends that come out. And then these last two, I kind of put them together. You'll want to take a look and see if you're subject to any of these limitations that we discussed, whether it's the interest deduction, whether it's the excess business losses. If you accelerate your deductions in the current year, you may put yourself in a situation where you're limited. So you'll want to coordinate all of these new provisions together. And those are some of the big impacts to you, things to take away. And I will now turn it over to Kris with some comments.
Thanks, Eric. I appreciate that. First, before we wrap up in the last question, we did want to bring to your attention that we have a lot of resources for you and your business. If you go to our CRI website, and the address is listed here, we have lots of good articles, graphics, content, some videos. In addition, you can see that we also have industry-specific topics. So we've also got some thoughts on how specific industries may be impacted by various aspects of the tax reform. So please, I encourage you to check that out. See if you can get some of your other questions answered that way. And lastly, we've mentioned this before, the schedule an appointment button. You'll see this on the CRI website. Again, the web address is listed here. If you have specific questions, I really encourage you to click on that link. It'll ask you for a little bit of information on when's a convenient time for you to meet, what office, CRI office, you're most convenient to you. And then you'll have a CRI professional who will reach out to you, schedule an appointment to have you come in and think through how tax reform is going to impact your business. As you can probably tell from our presentation today, there are lots of pluses and minuses that are part of this tax reform. There's not really a one-size-fits-all answer to give. So it really takes kind of sitting down and going through your specific facts and circumstances to figure out how tax reform is going to impact you. I think we may have time for just one last question that came in, and it's for you, Eric. The question came in on the new corporate tax rate of 21%. Can you clarify that corporate tax rate, does it apply to LLCs, S Corps, and C Corps, or can you clarify who that applies to?
So again, thanks, Chris. Good question. That's for C corporations. So if you have flow-through income, you're still subject to the individual tax rate. So that's correct. That 21% rate is for C corporations.
Okay. Thanks, Eric. I think that's all the time we have for today. So again, I appreciate everyone's attendance today. Hopefully you've learned something. As I mentioned before, a copy of this webinar recording will be sent to you in the upcoming days. So be looking out for that. And please go to the CRI website and schedule an appointment. We're happy to help you. Thank you.